this lesson, I'm going to take you through some key fundamentals in the subject basic finance. Now, basic finance, as you already know, is one of the subjects that's in the Zambia Institute of Marketing Certified Professional Program. A number of students, once they hear that there's basic finance, they get discouraged. But you shouldn't be. And I'm going to run you through some key fundamental points that will kick you off. You'll be able to answer some exam questions based on just what I'm going to present today. My name is Saboy, and my number is 0966930260. Feel free to WhatsApp me. Let's chat. I'll be happy to help you in your studies. Now, let's get straight into what I'm about to run you into. Only 8 fundamental points for now. Only 8 fundamental points to help you get started. Number 1 is you need to understand the purpose of accounting. And the purpose of accounting is so that a business can have financial information. To have financial information. What is financial information used for? Financial information is used for a number of reasons. Number 1, costing. Also, auditing. To ensure that the business is complying with set policies and set standards and set processes. Also, it is used to be able to price the products correctly. And also for investments. You see, when someone is investing in a business, they want to look at the financial statements of that particular business to see how it is performing. And this information is provided for by the very existence of accounting. Examiners may ask you why accounting exists. What is accounting for? And they'll give you answers, because that question usually comes under Section A. Section A is Section A, I wanted to say Section A is compulsory. Section A is multiple choice. There are 10 questions, and one of the questions that may be asked is, what is the purpose for accounting? So let's move to point number 2. I'm only going to run you through 8 very important points for this particular lesson. In the future lessons, we'll talk about other things. Number 2, you need to understand what is known as the accounting equation. What is known as the accounting equation. And it is as simple as assets is equal to capital plus liabilities. That is all. That is the accounting equation. And it is very important. You need to know and understand that assets is equal to capital plus liabilities. That is the accounting equation. Let's move on to number 3. Now, I'm going to begin to break down the accounting equation, and we are going to start with assets. Assets are those things that a business owns. Yes, take that. Very important. You own assets. And examples of the things that a company can own, e.g., machinery, stock, motor vehicles. The business owns these things. So these are examples of assets. Another important example of assets is what's known as trade receivables. What are trade receivables? Think of a company that offers cleaning services, and for its services it is paid at the end of the month. So today is the 20th of August. So I want you to think of a company, today is the 21st of August. I want you to think of a company that may have done the cleaning on the 9th of this month and is expecting payment on the 30th. Basebenza kudala ni ndalama zabo. So that's what's known as trade receivable. The business has done something, the organization has provided a service and is expecting payment. That is what's known as trade receivable. So assets are what a business owns. Number 4, liabilities. Liabilities. If assets are what a business owns, then liabilities are what a business owes. Very important. Mulinankongole as a business. So e.g., the business may owe Nkanya loan. Okay, you would need to pay. Okay, it's an example of a liability. You owe people money. Another is trade payable. Trade payable is like trade receivable, but you're looking at it from the other end. So as a business, that cleaning company cleaned for you, and today is the 21st. You have to pay them on the 30th. So you owe. They've already provided the service. You owe them. It's a payable. That's what that means. It's a payable. You owe them, and that's an example of a liability. So liabilities really are what a business owes. Number 5. Let's talk about classification. Classification of assets and liabilities. How are they classified? These are going to be classified as current or non-current. The principle is that with current assets or current liabilities, they have to be dealt with within 12 months. So if it is current assets, okay, current assets, these must be what you can convert into cash within a period of 12 months. Examples, e.g., stock. Another example, trade receivable, which I did explain, right? I did explain trade receivable. These are examples of assets. Prepaid liabilities. Prepaid liabilities. Are you thinking that, why is he talking about liabilities when he's talking about assets? Let's put it this way. We are in the month of August 2020, and let's assume as a business you paid for rentals up to June 2021. Those are prepayments. It means that you have secured assets, you have secured space. Malipira ahead. It's yours. You are entitled to a prepayment because you have already paid for it, and therefore it is an asset. It is a current asset. Then current liabilities, examples of current liabilities, since we're talking about current, so let me just talk about current liabilities. Again, within 12 months. And examples of current liabilities include accounts payable. I did explain accounts payable, right? I said trade payable, accounts payable. Okay, so that's but an example of current liability. Not just this, there's others. You may have gotten a loan which you need to pay back within maybe 4 months, 5 months, 9 months, 11 months, as long as it is within 12 months. So when we talk about current assets or current liabilities, it's an issue that has to be done within 12 months. Okay, or if it's current assets, you can convert what you have into cash. Cash, by the way, is also an example of a current asset. So you can put it there if you want to say cash. Okay, we already have stock there, and those are just examples of current assets. And examples of current liabilities include accounts payables, include loans, and also accruals. You can add accruals there. What is an accrual? To accrue is to let something compound. So for example, you haven't paid your rent in the last 6 months, so your rent has accrued. Mulinankongole, which has compounded or has accumulated over a period of time. So it is accrued because it has accumulated over a period of time, and that's something that you need to be able to pay within 12 months. Let's now talk about non-current assets. Okay, non-current assets and non-current liabilities. Let's start with non-current assets. Okay, assets. As you may already guess, these are long-term. Therefore, their use must be for more than 12 months. Examples of non-current assets include machinery, vehicles, long-term investments. What does this mean? It means that you may have gotten 20,000 kwacha and invested it on a farm somewhere in Dalamazano, but you intend to get back money, to make money over a period of more than 12 months. So that's what's going to make it non-current. Okay, but I must mention that non-current, I think the example I gave is not the best example, because it must be fixed assets. They are fixed assets, and potatoes are not fixed assets. I give an example of potatoes. So it must be like motor vehicles, because those are things that you use over a longer period of time. And then when we talk about non-current liabilities, non-current, okay, we are talking about things such as deferred taxes. I hope that's the correct spelling of deferred, deferred taxes. So you and ZRA may come together and agree to say, okay, ZRA will pay our taxes over a spread period of 3 years. It's a deferred tax agreement, and therefore, since that's running for more than 12 months, it's an example of a non-current asset. Another example is debt, which you have to pay, say, after 5 years. Okay, it's a non-current asset. Another example that you may wish to consider is what's known as debentures, but I'm not going to talk about debentures here. No one's pretty much going to ask you anything about debentures, but you can always look it up. So that is it on the classification of assets and liabilities, and that was number 5. We now proceed, and we'll be on number 6. What is number 6? We have already, so far we have talked about assets, and we have talked about liabilities. Now we need to talk about capital. Remember, we are breaking down the accounting equation, and the accounting equation is that assets is equal to capital plus liabilities. Let's go to where we're supposed to be on number 6, where we are now going to talk about capital. What is capital? Like you already know, capital is money that is used to begin a business. Capital, when we talk about capital, we break it down into 2. There's what is known as capital revenue, and this is usually used to, on the flip side of things, to when you're talking about what is known as revenue expenditure. And let me explain. Let's get back to this one. So capital revenue is money, right, that you use as a business to purchase assets that you're going to use over a long-term period. To purchase assets to be used, right? To be used over a long-term period. Examples of these assets are machinery. That's just one example. So when you get money to buy capital equipment, such as machinery, that is what is classified as capital revenue. Like I said earlier, when we are talking about capital revenue, there's always another topic which comes up, which is that of revenue expenditure. What is revenue expenditure? Revenue expenditure refers to money used to maintain